You automatically buy more shares when the market's down and less shares when the market's up, but it is not a substitute for a good investing strategy. So yes, dollar cost averaging can protect you in a falling market and it can work in your favor, but it can work against you in a rising market. Hey guys, what's up? I'm Erin and welcome back to Erin Talks Money. So you're excited to start investing. You've opened up your accounts, but now the question becomes, what's the best way to put your money into your fund or your funds? Should you throw it all in one lump sum, assuming you have a lump sum to work with? Or should you break it up into chunks and invest it periodically over time? Well, as with most things in personal finance, it depends on your situation. Today, I want to cover dollar cost averaging, which is one of the most popular methods that people use when it comes to investing their money in the market. So what is dollar cost averaging? Well, dollar cost averaging is investing a set amount of money on regular intervals. So let's say you were to invest $500 on the 15th of every single month. So the goal of dollar cost averaging is to help reduce some of that market volatility that you face by spreading your investments out over time, and also to eliminate the need to try and figure out what is the absolute best time to get into the market. Now, you may be already employing the basic premise of this plan without even realizing it, because if you take a certain percentage of your paycheck or an amount from your paycheck and invest that into an IRA or 401k or other investment vehicle, that's exactly what you're doing. Now, I know there's going to be some of those people who say,
well, technically that's not dollar cost averaging because you're not working with a lump sum of money, you're actually investing the total amount that you could in that moment.
But listen, let's not split hairs. It's still dollar cost averaging. It's got the basic premise of it. And if that's you and you're investing every single month, a big kudos to you, because that's what you should be doing, and you should celebrate by hitting that like button, as it really does help out the channel. Now, as with any investment strategy, dollar cost averaging has its pros and its cons. So we're gonna go over those, kicking it off with the pros first. Number one, dollar cost averaging avoids bad timing. Let's say you had a lump sum of money to invest and you invested it just prior to the housing market crash of 2008. You were unfortunate enough to hit the peak of the market and invest your lump sum, say $20,000, at the very end of 2007. You would have watched your money be cut by more than half, because from peak to trough during the housing market crash of 2008, the S&P fell 56.4%. That means your $20,000 would have fallen to just $8,720. However, if you had employed dollar cost averaging, you would have sidestepped the brunt of this crash, because instead of investing your $20,000 all at once, say you broke it up into smaller chunks, like maybe you invested $1,000 a month. Instead of investing at the absolute peak, you would have spread out your investment over a full 20 months before all of your money was invested. Now, of course, in this example, you are investing during a crash. So yes, your money would be going down. However, it would not have gone down nearly as far or nearly as fast if you were to have invested that full lump sum at the peak of the market before it took its tumble. Now, certainly, we can't predict the performance of the stock market in the short term. It's simply too volatile for that. We don't know when a recession is going to happen, and we don't know when a bear market is going to happen. But one thing is certain, with dollar cost averaging, you would prevent yourself from investing at the absolute peak of the market and taking that scary ride all the way to the bottom. And there is in fact another major perk associated with investing using dollar cost averaging during a downward time in the market, and that brings us to point number two. Dollar cost averaging forces you to buy low. You know that whole adage of buy low and sell high? Well, we all want to buy more of our investment when the stock market is down, and with dollar cost averaging, that's exactly what you do. For example, let's go with our previous numbers. Say you have $1,000 of a lump sum that you want to invest every single month. During month one, if you were to buy an investment selling for $50 a share, you would end up buying 20 shares. During month two, let's say that investment took a tumble and it's now selling for $40 a share. Now you would end up buying 25 shares, so you bought 5 more shares. During month 3, that investment went down even further, and let's say now it's selling for $25 a share. Well, if you put your $1,000 in, that means you would walk away with 40 shares this time. So each time the market goes down, you're buying more and more shares. You see, by investing a set amount at set intervals of time, you automatically buy more shares when the market's down and less shares when the market's up. And by buying more when the market's down, you end up with more holdings poised to make a comeback when that market does turn around. Let's return to our previous example and say you had been dollar cost averaging during the housing market crash of 2008. Every month you would have been buying more and more shares. Your money would have been going further and further as the market went down. When the market did inevitably turn around, you would have had more holdings than you otherwise would had you invested at the peak, and when they made a comeback, you would have profited handsomely. And that brings us to the final perk of dollar cost averaging, and that is that it reduces the emotional impact of investing during market volatile times. If you're working with a lump sum of money that you want to invest, it can often be rather scary to figure out that perfect moment to get in the market. As we all know, the stock market can be incredibly unpredictable and volatile, especially in the short term. Perhaps you think everything is overvalued right now and you're like, I think I'll just wait to invest. I'll wait till the market takes a tumble. So you sit on the sidelines. Or perhaps you think you're in the midst of a tumble, but you don't know where the bottom is. So again, you sit and you wait on the sidelines. But instead of just sitting on the sidelines and waiting to time the market, which we all know we can't do, instead of trying, you don't have to try and figure out that best, perfect, right day to invest in the market with your full lump sum. You can remove that emotional stress by breaking your lump sum up into smaller parts and investing it over several months. That way you don't have to sit there and fret about what is the very best day that I should get into the market. Now, just as dollar cost averaging has its pros, it also has its cons, so let's go into those. The first being that the market usually goes up. 2/3 of the time, the stock market goes up. Only 1/3 of the time does it go down. Historically, we have seen the general trend of the stock market is up. So the moral of the story is you're probably going to be investing in the stock market when it's going up. That means if instead of investing a lump sum all at once and you decide to break it up and into smaller chunks and do dollar cost averaging, you're probably going to be investing in a rising market. That means your money is going to go less far every single month, and you're going to be accumulating less shares than you would be had you just done a lump sum purchase. So yes, dollar cost averaging can protect you in a falling market and it can work in your favor, but it can work against you in a rising market. So let's again return to that example of investing $1,000 a month. During month 1, say the investment you want to buy is selling for $50 a share. With your $1,000, you would get 20 shares. During month 2, instead of falling in price this time, we'll assume that it went up in price. So now it's selling for $60 a share. That means you would get about 16 shares. If we continued that pattern, we would notice that your $1,000 would get you less and less shares every single month. So while dollar cost averaging does avoid bad timing in the market, it also avoids good timing. So that means you would have a less return or a less robust return than if you were to invest an entire lump sum if the market were rising. And number 2, dollar cost averaging will not protect you from poor investments. Yes, we can say that dollar cost averaging protects your downside in a falling market, but it is not a substitute for a good investing strategy. There's no guarantee that when an investment goes down, that it will go back up. Yes, in the long term, we can make the statement that the stock market goes up, but the same cannot be said for individual companies. Whether a company's stock price goes up or down depends on a myriad of factors, and there's no guarantee that a company's stock will go back up. We can make that statement about the general stock market as a whole, but not individual companies. Because if a company takes a turn for the worse, you have to know that dollar cost averaging will not be your saving grace if that company does not inevitably turn around. You still have to make sound investment choices, ones that are well researched and thoroughly thought out. Or you can always just invest in an index and eliminate all the guesswork. The choice is yours. In the end, the benefits of dollar cost averaging are far more likely to be emotional than they are strategic. Yes, it has its pros and cons, and it does have the ability to smooth out some of that market volatility. But being that the market does tend to go up long term, your gains are likely to be less if you were to invest using dollar cost averaging than if you were to invest a lump sum if you were to have it. Now, of course, most of us don't have lump sums to invest. As I said before, we're all basically doing dollar cost averaging if we're investing a little bit of our paycheck every single month. But that's okay. If you had an additional $100,000, certainly you might be better off if you were to invest it as one lump sum, but emotionally, maybe you'd want to spread it out. However, that's not usually the case. Most of us tend to just invest small increments every single month, and it's far better to be investing something rather than investing nothing. So let me know what you guys think about dollar cost averaging below. I love to hear your thoughts. I post new videos every Monday and Thursday. Also, if you want a new stock to add to your portfolio, sign up with the link down below. When you sign up for Robinhood, they give you a free stock. And also make sure to hit that like button, as it really does help out the channel. If you got anything at all out of this, please be sure to like and share it with your friends. It helps a growing channel like this, and I really appreciate it. Ring that subscribe bell so you're notified whenever I post new videos, and I will see you guys soon. Bye.